Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. So greetings, Boris. It's great to have you back on the podcast. I always look forward to our conversations.
Thanks for having me, and it's a pleasure to come back to MacroHive. And it's been always great to talk to you.
Great. Well, I thought let's jump straight into it. Obviously, since COVID, we've had a huge amount of macro volatility. Perhaps you could sort of describe how you'll define that macro volatility, because I've got my, I'll think about it in my own way. But perhaps you could describe it in your own terms, and then we can go from there.
Yeah. I mean, look, I think in the past we talked about, demand supply curves, the way they move. We talked about inflation and nominal growth. And we talked about fiscal policy, and I would say that it probably turns out that fiscal policy can generate quite big swings in nominal growth, and the Ricardian equivalence doesn't really hold at all times, especially maybe after prolonged periods of very low inflation. It looks like the unanticipated monetary shock that generates gains in output for a certain period of time does work after a longer period of low inflation, because not only economic agents but also financial markets are quite sticky in their preferences, and they're happy to hold fixed income assets maybe for longer than it's rational in a high inflationary period. Right. And that provides a kind of very benign environment for growth that carries on. Of course, policy then jumps in, given targets, and that, eventually turns things the other way. So you do have a volatility in terms of systemic volatility that is similar to kind of the wave function of a large shock. You have a high amplitude compression in the length, and then several waves. And I think that this will be the environment that will be defining, the next 5-10 years, which also is characterized as great macro environment. So it should be good for MacroHive as well.
That's great. I mean, one of the things that surprised many people this year has been how strong US growth has been. I mean, how do you think about that in the context of some of the things you just talked about, fiscal, monetary? We've obviously had a very aggressive, at least nominal terms, Fed tightening cycle.
Yeah, I indeed, I would say that the U.S. economy has a lot of things going for itself, but I would say structurally here, the big fiscal spending during COVID delevered significantly the private sector, and the interest rate sensitivity of the private sector has also declined on aggregate. Of course, the composition of the interest rate sensitivity is still there. You have certain sectors that have higher sensitivity to higher rates, but households altogether with their remortgaging have been less sensitive to the moves in mortgage rates duration. And corporates, some of the largest corporates have become large holders of cash as well, on which now they earn, the kind of the best Sharpe ratio real rate that's out there, right? So I would say maybe those two factors are key. There is you can call it a fiscal echo, which is a sustained period of higher growth after a large positive fiscal anticipated shock that carries on until there is some tightening on the monetary side that offsets it more clearly, and we'll be traveling toward that. And the key question is, when will that happen?
Well, I should ask you. Obviously, one big debate has been the soft landing versus hard landing. When you listen to Fed and ECB and just other central bankers around the world, they all talk about the soft landing. Is their base case rather than a hard landing recession. How do you handicap those different scenarios?
Yeah, when we talk about the future, I just want to quickly put in the disclaimer that this is purely my view, and I do not speak as employee of Goldman Sachs. My view is based on the models that I have been running, and there are various types of models, recession probability models, which look at various sectors of the economy, and practically they're trained on the last 30 years. They have three cycles, and they aggregate 0 to 1 signals, so to say, binary signals about the likelihood of a recession happening in the next 12 months. And most recession probability models are very kind of student focused to the shape of the curve. In our work, we are a lot broader. We get metrics from credit, metrics from the consumer health, consumer balance sheet, which we think is quite important, metrics from equities, and so on and so on. And what is quite interesting is that first, no two recessions are the same. The underlying factors have moved to a different proportion before any of the previous three recessions. There have been different characteristics. But also what is quite interesting at the moment is that there is the largest dispersion on record between the factors. So, equities, in the summer, equities were pricing only 5% probability of recession on 1-year horizon, while fixed income was pricing 100. And at that time, we thought that this divergence could lead to a bear steepening. And it actually was the case. It was one of the reasons why we were thinking the term premium can start repricing in late summer, because of that extreme inversion of the curve relative to the overall recession probability priced by other segments in the model. And indeed, that was the case. So I think that the other way to think about this time horizon is to try to estimate the relationship between increases in real rate and the opening up of the output gap, as we say, or the increasing the unemployment rate. And those models are pointing to a kind of similar horizon, both for US and Europe, which is the middle of next year at the earliest, right? So we are not into the camp of recession now. We were not in the camp of the recession now earlier this year, right? But we think that as we travel over time, the solvency element, which is the way high real rates were eventually, is going to start weighing more and more. One big difference is this time is that there is no issue of liquidity, and this is a very interesting deal.
Okay, yeah. Before we talk about liquidity and some of the other potential systemic risks or non-risks, I do have to ask you about the Fed. We're recording this before the Fed meeting, which the November Fed meeting, just that as a caveat, depending on when this podcast gets released. But what's your base case on the Fed? I mean, they seem to be, or the market at least, and when you speak to investors, people seem to think that the Fed is pretty much done. I mean, there might be one more hike possibly, but then they'll be on hold and they might start to cut next year as we then enter some kind of recession. We have others like Dominique and Macrohype, who's been forthright saying we're going to go to 7-8% based on a Taylor rule, but she's probably the outlier. How do you think about the Fed?
I usually draw my views on the marginals in policy based on either central bank conferences, meetings, interactions with policymakers, around IMF meetings. That's why I'm so kind of religiously following all the IMF meetings that are currently present. But
and you attended the most recent ones in Morocco as well.
Let me tell you what I learned from a conference in May in Vienna at the Austrian National Bank, which I thought was the most useful event which I attended this year. I think the framework in this situation is Claudio Borio's 3 stages of our double star. And he defines that brilliantly. Stage 1 being the weakest elements in the system get wobbly because of the increase in real rates. At that point, you haven't achieved your inflation goal. You use your tools that you have to support the system, but you keep tightening. This is the policy differentiation principle, one policy for one goal. At stage 1, are double star. And this is what we had in March. Stage 2 are double star is when your credit impulse freezes. And at that stage, he says you have to stop hiking because you may trigger stage 3 are double star, which is where you create random credit events that impair market liquidity and create market stress, and they can lead to big widening of bid offers and market dysfunctionality, at which point actually you get cut no matter what happens with inflation. You have your financial dominance trigger at stage 3 are double star, which you do not want to do as a policymaker. You don't want to hit stage 3 are double star. And I think that, what's interesting, our analysis of the credit impulse is that Europe is a lot closer to being stage 2 are double star than US. We can, and if I have worry that the Hawks may try to push for more hikes, actually, it's not in US, it's in Europe, paradoxically, right? In US, I think that based on the latest communication, including Chris Waller, I think that the thinking is we've done enough, and we can take the time to see how things work. And I very much agree with that attitude. I can tell you one metric which doesn't let me sleep well, which I think actually I'm worried that we are over tightening. So I'm personally siding a bit more with the Williams view, which is that short-term real rates might be extraordinarily high. And I think of the short-term real rate as a multiple of your R star or your long-term neutral rate. So our framework for example, to be bearish fixed income in 2021, 2022 was based on 5-year real rate plus 2 times R star, which was 5-year break even inflation, which was a 3% plus 2 times R star. So that was 4.5 basically. 1.5 is 2 times R star. We thought that this is going to be kind of the stabilizing. Why? Because we stabilized the 2005, 2007 cycle with very intense credit growth in a bubble with 2 times R star. The real rate went to 375 and R star was 2. So that was the kind of the stabilization ratio. At the moment, R star, estimated by the Williams model, is at 0.58, let's say 0.6. So, a front-end real rate, I mean, depends how you look at it, but if you take, 1 or 2 year break evens, it has been fluctuating between 2.5 and 4 this year. So you have a much higher multiple. And if I put that,
so if the the 2-year market real rate is more than double the neutral, the R star rate, then you're very tight in this framework. And I guess you can confirm this by looking at the credit impulse as well. If that's very negative, then you get validation from the credit data as well.
Or M2 data.
Or
exactly. M2 data. So if you plug those into a model predicting the output gap, it tells you that we would go from a very positive output gap that based on Dominic's work requires 7% to actually a massive opening of a big downside, output gap in terms of a serious recession down the road. Now, of course, a very important question is the timing, and the time elasticity of these effects is the key question there, right? And our earliest timing is Q2 next year. Based on everything I look at, that it looks like this might be extended even further. So one has to think more in terms of rates views, more for the Z4 to M5 area, rather than try to chase it too quickly here.
And just for the listeners' benefit, Z4 to M5 in which period?
It's December 2024 to June 2025. Sorry, that was the technical.
Yeah, yeah, no, that's fine. It's a futures market. And you mentioned the output gap, which necessarily implies the unemployment rate and labor market. And is there something about the labor market that has changed since COVID that might make our usual ways of looking at the unemployment gap or the output gap different this time around compared to before?
Yes, absolutely. The labor market is fascinating. I think we do have a lot of different um, factors happening affecting labor. Obviously, the COVID impact with the early retirement of a reasonably large cohort decreased the participation rate, and that was probably related to asset transfer during COVID. The second thing is, the work from home had an impact as well. And I think as well, the younger generation has different lifestyle preferences. And, a number of people like to have maybe two jobs at once or two careers at once and work, Monday, Tuesday, one job, and then, Wednesday to Friday, a different one. So there are a lot of things going on. And what I think is key, though, is that the demand for labor has been a function of the overall aggregate demand in the system, which has been supported excessively by loose fiscal. And I think that fiscal tighten. I mean, out of the 10% probably or 15% of the jobs numbers are public sector. So when we're thinking about labor market rebalancing, I think fiscal tightening would be a very essential element of that normalization. And what are the risks of running imbalanced policy? And imbalanced policy means too loose fiscal and too tight monetary. I think the most important risk is that actually you are affecting negatively the supply side of the economy. The productive capacity of the economy is going to be reduced, so you can re-anchor the economy at a higher inflation rate, and that is obviously would be an unwelcome development. One completely anecdotal example, and it might be imperfect, or there might be confounders there, but what I have been looking at recently is the decline in U.S. rig count. At the level of oil prices, which I think is quite reasonable, definitely above the marginal cost. This decline can be explained fairly well by the high level of real rate. It's one of the examples on how, if you have high real rates for a longer time, eventually you will have some impact on capital allocation, investment, and your supply is going to start shifting to the left, and you do not want that.
Because you want to increase the marginal return on that capital stock, so you're going to sort of scale it back until you get the higher marginal returns. Now that makes sense. Now you touched on term premia earlier in our conversation, and one of the other big stories of this year has been how the curve has steepened. 10-year interest rates in the US and globally have really shot up faster than the 2-year interest rates. That really occurred since the summer onwards, this bear steepening. So, what's your characterization of that? What's been driving it? Has it got further to go?
Well, there have been a lot of processes, a lot of paying flows from asset liability management, but also the overall shift from duration assets into money market funds, given the high Sharpe ratio return of cash, right? So that's a normal development in when front end real rates go up as much. And I think that also the fact that the labor market has stayed fairly resilient, and this discrepancy between what one part of the economy is giving us recession probability, what fixed income is giving recession probability, required some fixed income adjustment in the back end to lower that recession probability, right? So I think that's kind of the macro explanation. When we talk about the long end, I like two approaches. One is completely within the yield curve itself, which is the the term premium approach, which extracts, so say, a risk premium for the long end via regression techniques. And the other is an approach that decomposes the long end rate in two components: the long-term neutral rate, which is practically a sum up of inflation target plus your long-term R star. In this case, it will be 2.6, and an extra risk premium. And that risk premium you can then explain by various factors, of which the yield curve term premium can be one, right? So I would say the second approach would be more informative than the first. The first will give you maybe a consistent metric because it's comparable throughout all periods, and there you can see that actually there are different regimes of relationships. So term premium is not completely linear to the level of the 10-year rate, and in different situations, the relationship can even go kind of the other way, so to say, especially if you get like during the saving glut period, when there was a lot of buying from reserve managers, there was a distortion in that relationship. So what we are having, I think now we are having a repricing from a flat relationship between the level of the 10-year and the term premium, which happens when the whole curve is at a very low level, where you can have a term premium fluctuating between 0 and -100, and the 10-year rate staying around 2%. So repricing to a kind of steeper linear relationship, which is actually most of the time since 1960, where you have higher term premium, higher 10-year rate, and actually at this point in the cycle, 30 basis points term premium is about fair value, actually, based where unemployment is, based where front rates are. So we think that that was our call early in the summer, that we might see a repricing to 475 or 80. We traded as high as 5 in the 10-year, and we think that a good deal of the repricing is done. Now, the main problem is that there are 80 basis points margins of error around this 30. So if you ask me, can we see 550? I would say completely possible. I would be more worried if we go there, because obviously that works negatively on certain parts of the economy. But by and large, I think there's been a decent repricing. And
you mentioned one of the frameworks. Your second framework is inflation plus neutral rate plus some kind of term premium or risk premium. On the neutral rate, I mean, is it possible that that may not be 0.5, 0.6, and maybe 1% or 1.5%? Because in some ways that's a model, isn't it? The estimate of the neutral rate. So, how do you think about the neutral rate?
Yeah, and Mary Daly from the San Francisco Fed recently actually made a comment that she can see the long-term neutral rate, which long-term neutral rate includes the real rate plus the inflation target, right? That can be between 2.5 and 3, right? So she was sort of saying higher, which I assume, given that there is no debate about the level of the target. Yeah. It's a 2% fixed. It's about higher real rate. Now, what would be a higher equilibrium real rate driven for? I like to think about R star mostly as a reflection of productivity growth. And in order to have higher productivity growth, you need to have new technologies or a substantial change in investment needs that can lead to a new either productivity or quality of life. And I think we have two of those, definitely. One is, of course, AI, which is not that much capital intensive, but it will require substantial changes, probably in the data infrastructure of the economy and society. And the other is, of course, climate change and our investment in clean technologies and clean energy, which might not have immediate effect on the simple metrics of productivity, but is definitely going to have long-term effects on the overall productivity, in terms of overall GDP growth, because obviously we know and we can quantify what penalty on growth climate change and global warming is going to inflict. So in those case, because of those, because of the investment demand that would be necessary in relation to those, you can argue that this can start adding to an R star that in our current estimate might get too much of a legacy from the the period of sluggish growth and the deleveraging post Lehman. So yeah, the answer is this can be higher, and if that's higher, then this will explain a lot of the risk premium. So that risk premium, we think, on average in the last 6 years, should be around 100 basis points, and at the moment is around 220, right? But if we assign, let's say, 100 basis points to a higher real rate, let's say real rate's 1.5, then we are closer to equilibrium. It's there is no exact science there.
Yeah, and I guess the term premium is in some ways like a residual as well. So what you give on one side, you take from the other side. Actually, speaking about term premium, I mean, some people split it into real rates premium and then inflation premium. Is that something that you like to do as well, just to kind of go deeper into risk premium?
Absolutely. So again, that risk premium can be split in those two components and analyzing those two components. And the inflation risk premium would be any risk that might require an upward inflation target revision, for example. You can think about it this way, right? And I think that, again, global warming and the deglobalization, the trend of deglobalization together, there is work indicating that maybe adding between 1 and 1.5% extra to inflation, which would then raise the question: if we are targeting 2% inflation in exogenously driven higher inflation world, we'll have to have higher output sacrifice ratio. Of course, you can keep the economy at any point, at any level of inflation. You can keep it in deflation if you want. You just keep rates at 10%, you're going to have deflation, right? And you keep rates at 0 while inflation is high, you're going to have 20% inflation. It is a matter of policy choice. So the question is, the inflation target is not something that central banks set as a rule. An inflation target is a social choice, and if there are exogenous factors that require a debate on the inflation target, this debate is going to come sooner or later, irrespective of whether central bankers will never tell you we consider changing the inflation target, because then the whole framework falls apart, right? But society can have such a debate.
And in terms of different societies, presumably Europe has a different view on this compared to, say, the US.
I think that it is absolutely true. Different societies have different tolerance. The thing in Europe is that you have quite a different view on what's reasonable inflation in the south relative to the north. And there is a political economy associated with that. And I think that, there is nothing wrong of having different opinions when you are executing policy, and everything is a compromise. So I would say, about the moment, the compromise and the drift in Europe is more likely to be to the more hawkish northern side. And we had quite an extensive period where the more dovish southern side was on the steering wheel. So that eventually will take probably Europe to probably a bit more turbulent changing period than US in general.
Now, I did want to talk about some of the risks that could occur in the market. One surprise, I suppose, is despite the increase in policy rates and this higher volatility, that macro volatility that we've seen, we haven't had the big crisis. We had the regional bank crisis early this year, which many people were extrapolating out to be the beginning of something, but it turned out not to be. So for you, what are the types of risks or areas of the market do you think will be the most unstable in this type of environment going forward?
I mean, look, I do not want to narrowly define or speculate. I just want to say, in principle, there are three drivers that can create a shock, that can create a recession. One is energy. And I think that we have had phenomenal resilience in the first energy shock at the start of the Russia-Ukraine war. And part of that resilience is because we had a big fiscal buffer transfer to the private sector prior to that. And then there was also measures to smoothen that the effect of that shock. I would be worried about a second energy shock now, because obviously the buffers are lower, and maybe the incentive of policymakers to do transfers would be lower, because there was nothing that happened 2 years ago. So that's one risk. Liquidity generally can be a risk in tightening periods, especially when there's QT. We do see a strong relationship between G4 liquidity in dollar terms and risky assets. However, when it comes to US in particular, we have changed somewhat our mind about focusing narrowly on bank reserves in terms of liquidity. And the reason is that money markets, who now have almost 6 trillion of assets, have become increasingly active in overnight lending against collateral. And practically they perform for the system the function that bank reserves would partially perform, right? So they're obviously not as versatile as bank reserves, but, against treasury collateral, and there are almost also 6 trillion of T-bills in collateral now. There is plenty of collateral. There is plenty of short-end overnight liquidity, which generally is quite supportive for front-end investment-grade credit and financials as well, right? So that is a very strong element of the current point where the system is, that prevents shocks from happening. Then, of course, the third shock is solvency, and solvency is simply, in plain English, interest rates are too high and they're unaffordable to certain part of the economy, and that risk crystallizes normally in banks, in the financial sector, be regulated or shadow finance, right? So these are the two elements. And there, for those who are interested in exploring those risks, I would refer to the official publications, particularly Chapter 2 of the Global Financial Stability Report by the IMF is useful. They did a stress test of 900 banks. They think that in the group that banks that if there is a kind of some form of energy type of shock could be vulnerable, there are probably several GSIBs. So there are definitely things to think about. And then, of course, there are other publications, and that is, all the big economies, they have financial stability reports, Japan, and so on, and they do regular exercises. So I would recommend those students of the cycle who are interested in the solvency element to be keeping a close eye on all those publications, official publications.
And I know you look at EM as well. We haven't really talked about EM so far. I mean, how does EM fare, with this backdrop?
EM is the most divested asset, which is it is a function of several factors, not without reason. Number one is because when the Fed is tight, it's not a great time to be in EM, and people have learned the lesson there in the past 3 decades. That's one. Number two is deglobalization, which creates clear issues and rising geopolitical risks. And then number three is that risk premia in the developed world has gone up, and naturally the home bias is likely to increase. The interesting thing about EM, though, is that obviously it's a very heterogeneous group, and you have the savers EM, and EM on average is the large saver in the world, right? I mean, if you look at the distribution of current account deficit surpluses, you have UK and US on one side, running about $1 trillion, and you have Europe and Japan with a small but rising surplus, cyclical here, and you have EM running, close to or 800 billion of surplus. So that's how the distribution is. It's like 80-20 EM G10 in terms of surpluses. So that means that EM does not need to import capital. I mean, look, that's probably an incorrect statement to make, but EM does not need the funding to survive. You always need to import smart capital if you want to go up the technology scale, which EM, of course, badly needs. But the kind of the best survival is not an issue, apart from maybe a few vulnerable countries. And even they, given that there is again, as I said, a reasonable stock of liquidity, QT has not reached a point where is affecting the short-term liquidity. Even these countries at the moment, they are moving along. Okay, they have to pay higher risk premium. They're raising their risk premium in order to attract more capital, and if they do enough sufficiently, they will be attracting the marginal capital. So EM has interesting opportunities in a number of the so-called liquid high yielders, which are in the historical distribution to the 10-year rate in about 50th percentile, close to the mean of the spread distribution. The low risk EMs, or let's say is the low yielders, they are very tied to US, and they do not, I think, present on the fixed income side at least a very attractive opportunity. You are much better trying to find the right point to invest in the US 10-year then.
And just from a longer time horizon, we do now have much higher interest rates on cash. So from an asset allocation perspective, or just an investor sort of perspective, I mean, is it possible to beat cash? I mean, we've been so used to having a 0% hurdle rate, but now suddenly it's 5%. What do you think?
Well, absolutely. I mean, one should care about the Sharpe ratio of the holding. And I do think that in the period where the economy is still not delivering the signs that we are about to enter a recession, cash remains the most reasonable kind of high share allocation. But one has to be quite sensitive as to the timing of recession, because then you should be allocating even tactically to duration. I think in the next cycle, the curve will remain actually steeper than the post-Lehman, and term premium will steepen further in the next cycle. So as we say, we prefer steepeners than low duration into the next cycle. But again, duration will have its day, a few quarters even, when the right timing arrives. So yeah, I do think that being defensive here remains quite warranted, but keeping an eye on when to extend, so to say.
No, that makes sense. Now, when we talk about productivity, you did mention AI. So, and I know you are very much into AI, machine learning, and this whole area. So, what are your thoughts on how we can use AI in finance, and how do you think it should be implemented?
Look, one great thing that happened in the past 2 years is that the transformer models delivered a result that caught the attention of the broader public and the corporate board as well. So AI is a real thing now.
And by transformer, you mean the technology that allowed ChatGPT to come about?
Exactly. Yes. And that's great, because it will increase the R&D. When it comes to finance, obviously things are a lot more complicated, and it is kind of the nature of markets versus nature of reality. Reality is a lot more a constant variance process. Things may change and move in terms of, wind and animals, but the structure of things is very stable. Evolution is a very slow process, and language as well changes very slowly. If you live abroad from your native country for a long time, you come back, like me. I'm spending a couple of days in Bulgaria. I practically been living outside for almost about 30 years now. There is some differences, so the slang, but still 99.9% of the communication is working. Finance is a random walk to a large extent, to the largest extent available, actually. The only process that is probably closest to finance in terms of randomness is war. And that's why it's incredibly difficult to predict. Self-driving cars, they are martingale probably 95%, and they really face challenge modeling the 5% randomness as well. So the way I think investors should be approaching AI for finance is to still try to augment the decision-making process of the human decision maker. Why? Because we are very good at identifying regime shifts, and we have extremely sophisticated attention mechanism to focus on what's relevant and to filter what's not. That is critical, and that can be augmented quantitatively, right? What the transformer models or the ChatGPT models allow us will be to create these so-called co-pilots, which will integrate verbal and quantitative analytics and results to answer a verbal question. They will be able to generate the Python model that will deliver the result that's asked in the question in terms of either structural analysis or forecasting. But again, to come back to the original question, I think actually that the body of the work that we have to do in AI is data. Data should be the focus. Data is 95% of the AI work. And there is a lot being done. There are a lot of companies emerging that do very interesting stuff. I think, though, that there is a social element to it. And, my high conviction is that the public sector has its role to provide and build a secure, trustworthy data infrastructure that collects anonymized, completely anonymized data from all the entities that generate data and provide that data as public utility. And that anonymized data can provide the infrastructure that can create an AI explosion in terms of development, in the same way as the internet and the 3G, so the faster wireless networks created the businesses that deliver streaming and so on, right? So I think that that's more likely to be implemented in Europe and can give Europe actually an interesting edge to leapfrog and come back kind of technologically to the AI map, because at the moment it's lagging behind.
That's great. Well, we've covered a lot of ground, and I could have you on for much longer, but I think maybe let's stop there. So once again, thank you very much for taking part in this conversation. If people did want to reach out to you, is there a way they can somehow connect with you?
Absolutely. They can collect on LinkedIn, which is the easiest way, or via you. You can probably share some details.
Yeah.
But it's been a pleasure as always. Thank you so much for the time, and talk soon.
Yeah, absolutely. Thanks a lot.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. we'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.